Hey, what's up everyone? My name's Dave Meyer, Vice President of Data and Analytics here at BiggerPockets. And each week on Fridays, I recap all the financial news and information that you need to know to be an informed investor. And last week, we talked about how housing prices continue to go up and are not showing any signs of slowing down. And this week, I want to talk about the stock market and just how, like the housing market, it is continuing to hit new highs. Now, I know that BiggerPockets is primarily a real estate channel, but if you want to be an informed investor and you want to earn the best returns for yourself, you need to understand what's happening in the broader economy. After all, investing is all about resource allocation. Where do you put your money to achieve the right balance between risk and reward? And on this channel, we primarily talk about just one asset class, and that's real estate. But to form your own investing strategy and to maximize your returns, you need to consider and to understand a variety of asset classes. For example, I know a lot of real estate investors who are sitting out the current housing market and are looking for other places to invest. So today we're going to talk about what's going on in the stock market, why this is happening, and whether it's going to continue. Before we do that, please make sure to give this video a thumbs up and to subscribe to the BiggerPockets YouTube channel. It would be a great favor to all of us. All right, let's get into what's going on in the stock market. Last week, the S&P 500, which is one of the broadest and most important indexes of the stock market, hit another all-time high. At the end of the week, it was up nearly 8% in Q2. And it's not just the S&P 500 either. As of this recording, the Dow Jones was up even higher on the quarter, between 9 and 10%. For reference, the S&P 500 has average returns of about 10% per year going back over 50 years. So a quarterly return of 8% is huge and is excellent news for anyone who is currently investing in the stock market. And since the steep drop in stock prices back at the beginning of the pandemic in March of 2020, the S&P 500 has grown an outstanding 87%. I mean, that is pretty much as good as investments get. In other good news for stock investors, the CBOE Volatility Index, which is sometimes referred to as the fear index for the stock market, hit its lowest mark since February of 2020. And with this index, lower is generally better. It means investors have more confidence. And the fact that this index has now hit its lowest mark since February of 2020 signals that investors are not just seeing great gains, but they're gaining confidence as well that these gains are going to be sustained and they're going to continue growing into the future. So right now, it looks like a very good time to be a stock investor. But let's examine why this is happening and what's likely to happen next. There are two major fundamentals to a stock's price: the company's earnings and the price to earnings ratio, which is basically a measurement of how much an investor is willing to pay for each dollar of earnings the company has. Now, of course, before you get all crazy and yell at me in the comments, there are a lot of technical and emotional social factors to a stock's price. And in today's economy, you need to take into account the new economic recovery, these low interest rates, and there's so much more to a stock price. I acknowledge that. But in the interest of time and in this video, I'm just going to talk about these two fundamentals: corporate earnings and the price to earnings ratio. First, corporate profits are up. If you look at this graph from the Federal Reserve, you can see that corporate profits dipped considerably in Q2 2020, which of course makes sense given everything that was going on in the world at that time. But since then, it has just gone up and is now reaching new highs. And when corporate profits go up, the stock market tends to follow. The second fundamental is the PE ratio, or the price to earnings ratio, which again is basically just how much an investor is willing to pay for each dollar of earnings for a company. So if the PE ratio stays the same and profits go up, the stock price is going to rise. But what happens if the PE ratio climbs at the same time as corporate profits are going up? Well, that is exactly what's happening. And in those cases, stock prices are going to go up even more dramatically because corporate profits are going up and the amount each person is willing to pay for a stock for each dollar of earnings is going up at the same time. So that sort of compounds that growth. And so that is exactly what is happening here and what we're seeing in this rapidly expanding and growing stock market. Now, it's important to note that historically, when the PE ratio rises, a correction or crash in the market often comes right after. This is important to know. We saw this when PE ratios jumped in above 45 in the dot-com bubble, and then again in the financial crisis. And right now, the average PE ratio for the S&P is above 40. And generally, we haven't been able to sustain PE ratios above 30 or 35 for a long time before a correction. So seeing the stock market grow because PE ratios are going up is not always a good thing, and it can be a bit of a red flag. Basically, valuations like this can mean that stocks are overpriced. But on the other side of the argument, many investors see the stock market as the only game in town right now, and therefore these valuations are sustainable. Like I said at the top of the show, investing is all about where to put your money to best balance risk and reward. And right now, there are very few asset classes that offer good rewards. Typically, safe investment like bonds are offering ultra low returns right now that are not even going to keep pace with inflation. Crypto has been on a weeks-long slide. Gold is generally unexciting, and cash is probably going to lose value due to inflation. That leaves the stock market and, of course, real estate investing. But of course, let's be honest, a lot of institutions and a lot of individuals don't want to invest in real estate. I mean, personally, I don't really get it. I love investing in real estate, but to each their own. But the point is, if investors don't like the idea of investing in bonds, cash, gold, crypto, or real estate, they need to put their money somewhere, and they're going to put it into the stock market. According to the Wall Street Journal, individual investors and corporations are likely to pump another $500 billion in stock purchases into the market through the end of this year. So with all that money flowing in, many argue the markets will be able to sustain this high valuation even though it hasn't happened in the past. So what happens next? The thing to look for is earnings seasons for Q2 starts in July. And during that time, we'll be able to see if corporate profits continue to rise to new heights and take stock prices with them. Personally, I think they are going to, and I think the outlook for the market in the short term looks pretty strong. Many indicators show that the overall economy is growing, and my belief is that corporate earnings will reflect that growth in coming weeks. But of course, that is just my opinion. I should share that in general, the consensus among investing professionals seems to be that stock market growth will continue through at least the end of 2021, but likely at a slower pace than what we've seen in the first half of 2021. Personally, I'm not betting on any more 8% quarterly returns for a while. And with PE ratios as high as they are, I think it's important to keep a very close eye on inflation and interest rates. If those change, they could alter the dynamics of the economy, and they can make other asset classes like bonds or real estate or gold become relatively more attractive than the stock market. So for real estate investors who are sitting out the current housing market or who want to grow their money while saving up for their next property, the stock market could present an attractive alternative, at least over the course of the next couple of months. Just remember that there is risk in every single investment. So invest responsibly and always prioritize long-term goals over short-term gains. All right, I'm Dave Meyer for BiggerPockets. Thank you guys so much for watching, and I will see you all next week.